Welcome to part 2 of this special On the Money update on the 10th of July 2012. Now in part 1 I showed you a couple of examples of how extreme variances of price away from their averages are well worth watching out for and taking seriously as a sign of potential strength or weakness. And remember, in the second example we looked at how 2 consecutive months in the Dow, which both opened and closed below a 2-month average, was a reliable sign of major weakness to come. Why would that be? Well, one heavy down month will almost always lead to a period of mean reversion. But when 2 occur back to back, the market is telling you there's not enough buying interest to stage even a modest recovery. Seems to me that's why the signal works. Well, on Monday, SPY, the S&P 500's trading proxy, spent the entire day trading below its 3-day exponential moving average, just as it had done on Friday. 2 consecutive days below the 3 EMA. Why choose 3 days and not 2 as I did with the monthly chart of the Dow? Well, incredibly, in its entire history, going back 20 years, SPY has never spent 2 consecutive days trading below its 2-day moving average while being in an uptrend. During an uptrend, which I define simply as holding its 20-day moving average, if it fell below its 2-day average, it's always rebounded on the second day. But if we make it a 3-day average, it still only produces 2 examples like this. The second, obviously, was yesterday. Here is the first. March 21st, 1994. In 8 trading days, the market fell by 7.5%. It was almost the manner of the fall which was almost more shocking than the fall itself. There was a brief rebound attempt in the 2 days following the signal, but this was the clue that selling pressure was intense and the dam got busted straight away afterwards. Now obviously this is different to the examples I showed you in the previous video. It's only on a daily scale, not a weekly or a monthly, and there's only one prior instance, so we really do have to be careful not to take this as a sign of inevitable doom. But this is not the only technical warning sign we've had in the past few days. Here, let me show you. Last week I posted a market update where I showed how extreme the McClellan oscillator had become and how weakness in the indexes followed in 37 out of 38 similar cases since 1998. I've also tweeted about other less dramatic price patterns over the past few weeks, which did suggest we would retest these early June lows. Well, it's not possible to say categorically that we will, but when you put all this stuff together, the signs ain't good. Plus, looming over these short-term worries, we've reached a potential turning point in the 3 peaks and a domed house sequence I wrote up back in May. You know, what it means is we could be here at point 27, heading for here at point 28. So the bottom line is I continue to believe, taking everything into account, we are approaching a multi-month low in the stock market, somewhere from here to here. It seems to me, though, that the indexes are going to have to take another sock in the jaw before we reach that low, but that once we do reach it, we should rally to a new bull market high over the next few months, which may prove to be the eventual top. But whether it does or not, I put the likelihood of new highs at roughly 70%. But that means there is a good 30% chance that the coming drop will fall well below the June lows, letting the world know a major new bear market has begun. Now that means that right now is almost certainly the riskiest time to be long, with a fall likely to come whether or not we hit this low or go well below. It seems to me the smart play, if you're still long, would be to use any minor strength over the next few days to lighten up. And if the market falls, as I expect, we'll watch for telltale technical signs of a major low forming before we can get back in. Or if this signal proves a crock and the market surges above its recent highs on strong momentum, no harm done, get back in and ride it to the top.